This is the Best Stocks to Buy podcast. Looking for quality stock tips? Well, we bring you timely investment ideas based on the latest stock and market outlooks. Our ideas are driven by a proprietary software that reviews, analyzes, and ranks over 6,000 stocks every week. So you may hear the name of a company you haven't heard of before. And you know what? That is often the best kind of opportunity. An opportunity to get in early before the investing masses. The Best Stocks to Buy podcast is made possible by Conner Management Group, a registered investment management firm serving individuals, business owners, and family offices. Hi everyone, this is Mathis Conner with Conner Management Group, and this is the Best Stocks to Buy podcast. Today is Monday, December 19th, 2016, and this week we're going to be looking at the best growth stock to buy right now. And on to our opening slide. It is called The Setup and the Approach. Now, the key objective of this podcast is to find and present to you a high probability upside potential stock. Our key tool, it's a financial model, a proprietary tool we developed that uses multiple valuation approaches across over 6,000 stocks that we review every week. So the view you're getting is not driven by some sensational headline in some popular publication focused on increasing readership, but based simply on the best investment opportunity. Now, an easy way of thinking about our approach is to think about the method of triangulation that law enforcement uses to locate a cell phone. In our case, we use a form of triangulation to locate a future stock price using different valuation methods. Here's the backdrop. Now, I truly viewed creating such a model as daunting, but we believed we was prepared for the challenge. I have both computer programming experience as an engineer and over $15 billion of transaction experience as a finance and development guy to judge the research I reviewed. So my approach didn't come overnight. I painstakingly reviewed over 40 years of white papers, taking away the best that each had to offer, and then added some of my own tested intuition to implement new data sets that weren't even available as little as 10 years ago. Furthermore, my model uses both historical and projected values and takes into account management's historical accuracy of meeting the projections they share with the public. A point worth remembering is that these views are based on the conditions of today. An unforeseen economic report, a regional conflict, a revised policy can change these expectations tomorrow. And the benefit of using a professional money manager like Conner Management Group is having someone experienced in making educated assessments about the unexpected, as well as having someone to readily share their opinion on whether a particular event is reason for concern. And now, so what did our model find for you this week? Turns out that the best growth stock to buy is in the specialty retail industry. Now, just to level set, we're going on to a slide called the industry overview. The specialty retail industry is comprised of a diverse group of companies that serve the consumer population with a variety of products and services. So here are the 10 largest publicly traded competitors in the North American stock exchanges. Best Buy, Bed Bath & Beyond, Murphy USA, Liberty Interactive, Hertz Global Holdings. Those are the first 5. The next 5 competitors are GameStop, Avis Budget Group, Dick's Sporting Goods, Signet Jewelers, and Insight Enterprises. The growth drivers in the specialty retail industry are basically 2. Simply right now, we've got positive and stable consumer spending outlook and increasing e-commerce demand. A lot of online purchasing growth is still happening. The industry challenges for these type of competitors and companies are reduced consumer traffic to brick and mortar locations, increasing online competition, and labor cost pressures. Unemployment rate's pretty low right now. So, and now for the big reveal. The best growth stock to buy right now is a company called HSN Incorporated. You might know them better as the Home Shopping Network. Their ticker symbol is HSNI, and we see their 6-month upside potential at a very healthy 35%. On to the quick facts slide. Here's a business summary description of HSN. HSN Home Shopping Network Incorporated offers products on TV, online, in catalogs, and in stores through 2 segments. HSNI operates through their HSN subsidiary, which comprises 69% of sales, and their Cornerstone subsidiary, which comprises 31% of the sales. The HSN segment offers jewelry, fashion apparel and accessories, home electronics, culinary, and other products, as well as beauty, wellness, and fitness products through television, home shopping programming, broadcasts on the HSN television networks, and other direct response television marketing. Now, the breakdown of the sales within the HSN segment is about 53% are home-based products, 24% beauty and health, 15% fashion, and 8% jewelry. Now, the Cornerstone segment provides home furnishings, including indoor and outdoor furniture, home decor products, tabletops, textiles, and other home-related goods under the Front Gate, Ballard Designs, Grandin Road, and Improvement brands, and apparels under the Garnet Hill, Travelsmith, and Chasing Fireflies brands. And a lot of those sales come through their distribution of catalogs. Their website is www.hsni.com. The company is headquartered in St. Petersburg, Florida. They were founded in 1981, and they have 6,600 employees. Onto the metrics slide. The annual revenue for HSN over the last 12 months was $3.6 billion. Their net income was $135 million, and their cash from operations was $213 million. Their operating margins for 2016 are tracking to be 8.5%, and for 2017, the operating margins are projected to be 9.5%. So a nice little uptick expected there. The trailing PE ratio, onto the valuation metrics, the trailing PE ratio right now is 14.0, and the forward PE ratio is 10.4. And that relationship between the trailing and the forward PE ratios implies that earnings are expected to increase over the next 12 months. The PEG ratio is at 0.4, which is always good when it's less than 1. And the price to sales ratio is at 0.5. And the price to book ratio is at 11.7. And the enterprise value to EBITDA ratio is at 8.3. A nice surprise on this growth stock is that right now the dividend yield is at 3.9%. And for HSN, the average dividend payout ratio is 33%. And the payout ratio essentially means the percentage of their earnings that they pay out annually in dividends. On to the price chart for HSN. The stock has pulled back since the early summer months. Since June, August, the stock was around the $50 range, and since then it has experienced a pretty strong pullback, now down to the $35, $36 range. Now, the reasons for those declines are basically less than expected sales for 2016 to date, and due to an unattractive product mix, their consumer preferences can vary, and companies don't always get those right. And additionally, they had a recent earnings miss. So on to the next slide, the looking back and looking forward. Under the looking back heading, We have sales for 2016 have been coming in below projection. The product offering for 2016 has not met consumer preferences. Strong sales in electronics and beauty were offset by weaknesses in other categories. The general market weakness in the outdoor furniture category has led to promotions and discounts which have impacted HSN's cornerstone business segment. Additionally, the recent quarterly earnings came in below expectations, as we just mentioned. So consequently, the stock experienced a pullback from around $50 per share in the early summer to down to around $36 per share right now. Now, looking forward, HSN is changing its product offerings to achieve a better overall profit margin. HSN is partnering with popular internet search engines and social media platforms. So these are our new endeavors. The company is automating parts of its distribution network, and it's expected to generate notable savings going forward. The company is now paying an above-average dividend yield of 3.9% against a strong balance sheet, which makes this an attractive stock on that point alone. The recent stock pullback appears to be a market overreaction, in our opinion, making this an attractive opportunity. So the projected earnings suggest that the stock is now inexpensive, and this is making it a quality purchase opportunity with an above-average dividend. So there's your looking back and you're looking forward. On to the next slide. It's called the Why Now, the bull rationale. And our reasons are basically fourfold. The company is still expected to have increasing sales per share going forward. Right now, the company has a low valuation metric right now, and it's expected to have an even lower valuation metric in the near future. And additionally, the company is expected to buy back its shares. So increasing sales and revenues per share, low valuation metrics right now, low valuation metrics in the near future, and share buybacks we view are as the reasons for pressure on the stock to increase. On to the summary slide. The financial statement quality of HSN is very good. The operating margin trend is flat, though it is expected to increase slightly over the next year. The price pattern trend has been declining. We view this simply as a market overreaction. And the industry outlook is positive. Consumers are still purchasing a lot of retail goods. The overall market outlook we view as also as positive. Unemployment is still low, and GDP is expected to be in the 2.5% plus range over the next 6 months at least. So we're feeling pretty good about the backdrop of HSN as well as the company itself, and we believe that it's definitely at a bargain price. Right now, the closing price is at $36.25, and we view the 6-month price target as $48.36, which gives this company a 6-month upside potential of 35%. So it's for all these reasons that we believe that HSN is the best growth stock to buy right now. We hope you found this presentation helpful, and we'll talk to you again soon. Take care. Bye. Hello, everyone. This broadcast was made by Connor Management Group. We are a registered investment advisor and money manager for individuals, businesses, and family offices. We are not your typical financial advisor in that we invest our clients' funds directly into individual stock positions. We do not put our clients into other stock mutual funds. At Connor Management Group, we help you grow and protect your assets. We craft high-growth investment portfolios for your children and other minors. We manage the rolled over assets from 401k accounts. We manage IRA and trust accounts. So how do we go about serving our clients? One big differentiator is that we developed some pretty comprehensive computer software that reviews, analyzes, and ranks over 6,000 stocks on a weekly basis. And from that, we create concentrated investment portfolios of well-researched and closely watched stocks. Furthermore, we operate under a managed account arrangement, and that means you open and fund a brokerage account in your name, and we simply manage your investments electronically. That gives you, our client, the greatest control and transparency possible. You can learn more about our service at www.connermg, that's CONNERMG.com. Additionally, we've set up a group on the LinkedIn platform. The name of our group is simply called Stock Investing Tips, Better Returns, Bigger Pockets. Now, this is a private group, which means you have to click the Ask to Join link. We do this because we want to be able to control the quality of the member experience. So if you like what you heard and you would like to receive more timely investment information and be able to post questions, just send me a message to ask to join our LinkedIn group. You can readily find my profile on LinkedIn. It's Mathis Conner. That's MATHISCONNER. And if you have any problems connecting, just send me an email at mathis@connermg.com. Well, that's all for now, and I'll talk to you in our next broadcast, or hopefully with you in our LinkedIn group. All right, everyone, have a great week.